come essere sicuri in DeFi, Dev Core, DeFi Finance. Ladies and gentlemen, welcome to AllTrades.
Yeah, they should load it. So next and back. Okay, great. Hello, everybody. So this will be my first presentation ever in Italy. Kind of exciting. And so let me see if this works. There we go. Okay, so my name is AllTrades. I'm a core dev for DeFi Finance, which some of you probably know of, especially if you're in decentralized finance. You will probably have heard of us. And my presentation today is about how do we stay safe in DeFi and gather our yield, right? So let's move on here. First of all, why are we in DeFi, you and I, right? It's pretty simple, right? Because we want to put our money to work. We want to earn yield on our crypto instead of just trading it, right? So to be effective in this, we need to know where the risks are and to navigate them intelligently. I mean, that's basically why we go to DeFi at all. Okay, so, oh, I need to press this, sorry. Why though DeFi? Why go to DeFi at all? Because we can also make yield on a centralized exchange. Well, CEX is a centralized exchange, are there for cheap, flexible trading, principally, right? You can earn some yield there, but if you're a longer-term investor and you want to focus on that yield, on holding your tokens, you want to earn as much yield as you can. And anybody who looks around will see that the yields on DeFi are quite a bit higher than you will find on a centralized exchange. So another reason why you might want to move to DeFi as well is that you know that centralized exchanges have their own risks that are involved. And in fact, real crypto takes place on the actual blockchain, not in centralized exchanges. Centralized exchanges actually hold all of their crypto in one way or another on the blockchain. So if you take your crypto out of a centralized exchange, you are operating more directly. You don't have a layer in between you and the blockchain itself anymore. So you have more control that way. Naturally, you need to do that in a smart way, though. Centralized exchanges, as we've seen in the past, also have their own risks. They don't necessarily protect your crypto better than you can protect it yourself. It's another layer of risk, in fact. And to remove that risk, you can just, like I said, move your crypto into DeFi. Okay, let's see here. So now let's move on to the main topic that I wanted to talk about today, and that is how do we stay safe in DeFi? I have a few rules that I put together that really that we should follow. And first of all, absolutely the most important thing, rule number one, is educate yourself before you invest. You need to know, you need to kind of understand what you're trying to, why you're going to buy a particular token and actually hold it. If you get, you see an amazing APY that you want to invest in, that a yield farm is offering in terms of rewards, you may be attracted just to that APY. Well, that really isn't where you should start. You really need to educate yourself on, is this token that I'll be investing in something that will maintain its value or go up, right? So you need to read a lot. You can listen to good podcasts that go into whatever it is that you're trying to invest in. You can watch good videos, but I think really to get the best information, it's usually in written form, and you should read a lot about every aspect of what you're trying to do. Another great option in doing this as part of the reading process is to join a community of like-minded folks, who are interested in DeFi and in gathering yield, and ask questions there, like in a Telegram group or a Discord group. Actually, Beefy Finance, which is the protocol I work with, has one of the largest Discords in all of DeFi. Thousands of users come in there and learn about Beefy and decentralized finance itself, and everything, all the yield farms that Beefy supports are discussed in there. And so you can learn a ton just by interacting in those communities. Rule number 2 is, okay, you educate yourself. This is a new area that not everyone is used to. Start small. You don't want to go crazy right at the beginning. You need to get a feel for how things work, because there's a lot of touchy, little nicky-knack things that you need to get used to in this area, with working with a MetaMask, working with a wallet. How do gas fees work? How do you bridge tokens from one blockchain to another? There's just lots of things like that you need to get used to. So start small is usually a good way to do it. Rule number 3 is, like I alluded to before, is you don't want to be just attracted to unbelievable yields. You might see some APYs out there that say 1,000% or even 1,000,000%. Obviously, the only way, those aren't sustainable, never, pretty much, right? There's only for a short period of time, and often those tokens will decline in value very fast because people will acquire them and then dump them. And so it may say that you're going to be earning 1% a day in yield or 1,000% a year, but if your underlying token falls too much, you are not going to make money that way. So you need to avoid things that are brand new, shiny, too good to be true, unless you have a very good reason, unless you've done that research and you have a good reason for believing that it will sustain its value. So one thing that you can look for when you're looking at a protocol is, has it been audited? And who has it been audited by? You need to make sure that it is by a respected auditing firm. And you can learn which ones are respected in these communities like I talked about, like Beefy's Discord, to find out which ones are respected and which ones you should actually put some faith into. Because there's a lot of audit firms that are out there just to make a quick buck, just for marketing purposes. It happens all the time. Another thing is that with the protocol, does it have a bug bounty? All these protocols, usually in DeFi, have smart contracts that, if they have any kind of vulnerabilities in them, black hat hackers can attack those protocols and drain your money from your investments, right? And you lose money that way. So if a protocol actually puts out a bounty saying to the hacking community, please come attack our code, find our flaws, that really helps build credibility for everyone. So if a protocol does have some sort of bounty, that's a plus. But even more important to that is, has that protocol actually have they actually paid out a bounty before? Because it's one thing to offer, say, we offer a $100,000 bounty, and then a hacker comes in and says, okay, you have these problems, pay me my bounty. If the protocol doesn't actually do that, then obviously they're not really, they're just doing it for marketing, and that's not useful. So again, just to reiterate, those are just to start this conversation off. It's about gaining practice and being cautious, you'll gain comfort. And then you'll be prepared to scale up, so you won't have to stay small, like I talked about as rule number 2. You can start putting more money into it and trusting what you're doing because you became more of an expert in what you're doing. Okay, so where is yield found in DeFi? There are 2 main sources, main protocols where you can find yield. That is areas where you can make money by lending your crypto to a protocol. The main one that everyone typically knows about are yield farms. So you lend your crypto to these yield farms, and they give you rewards. Usually those rewards, almost always, is in their own token, which is inflationary. And by inflationary, I mean that they keep printing, minting more of their token as rewards infinitely. The other area where you can earn yield is by lending it to a lend-borrow market, like Compound on Ethereum, or Venus on BNB chain, or Geist on Phantom, and where you lend your crypto, and then you get paid interest for lending the crypto. Okay, and then another area where you can earn yield, and actually it layers on top of the first 2 I just spoke about, and that's yield optimizers. And that's kind of a sweet spot, because what an optimizer does, a yield optimizer, is it compounds the yields that you're earning from all of these protocols, from a yield farm or from the lend-borrow markets. And beefy.com, the protocol that I work with, is one of the main leading yield optimizers in DeFi. We're on 15 different blockchains, Ethereum-compatible blockchains, not on Ethereum itself, but everywhere else that's Ethereum-based. We're like the 2nd largest yield optimizer in all of DeFi. Okay, next. Okay, where are the risks? Because that's what we really fear, right? In DeFi or in crypto, is that we don't want to end up losing money and losing our investments. So how does that happen, though? First of all, obviously, we've probably heard of rug pulls, which is basically cheating, where people steal our crypto. How does this happen? Anybody who comes into DeFi will see these things immediately. In fact, I fell victim to it right in the beginning as well. And that happens where a good story, a good technical story, is pitched, is hyped by known players in the industry, or at least they claim they're known. They seem like they're known. They may have fake profiles on LinkedIn, things like that. They write some documents describing what they're trying to do. They may even make a fake GitHub with fake code inside of it, or have taken code and copied it from someone else and put it in there, so it seems legitimate. They can open up a Telegram channel and hire some moderators that they give them a few sentences to say all the time, and try to have them help hype the story and answer questions. They'll hire a big Twitter shiller, which are people on Twitter who have hundreds of thousands of users and are paid by these new protocols to hype their coin before the actual coin is offered. This will happen over a week or 2 to get people excited about it, all the opportunities, how great this is going to be. And that's a really key area for getting new investors in there and getting excited for the actual offering, which happens on usually a 2nd-tier DEX. A DEX is a decentralized exchange. We know these like Uniswap or SushiSwap, PancakeSwap. Those are 1st-tier DEXs. You won't find these horrible rug pulls so much on those DEXs as you will on secondary ones. So on BNB chain, it could be anyone other than PancakeSwap, for instance, might be a secondary DEX, and you would have to have extra attention on any kind of coin offering that happens there. So they launch on these second-tier DEXs, and then within hours of offering to the public and people buying in and seeing the tokens spike up, they pull the rug. They sell all of their supply that they've set aside for the dev team or something like that, and the price falls dramatically, very, very quickly. Everybody's rushing to get out, and it goes to the floor, and you lose all your money. The other way that we lose money in DeFi, the risks, are where there's bad code in the smart contracts or on the front end, but usually the smart contracts themselves, where hackers will identify flaws in the code. And that's where auditing firms come in to try to find these things, but they're not always successful. And in fact, protocols can often update their smart contracts, add new features, add new code, and not update the actual audit, right? So that's another source that happens a lot. And in fact, we see that Beefy Finance has been around for since October of 2020, so 18 months. We've been forked many times by other protocols, because they see the value of a yield optimizer, which is such a simple thing, where you just want to compound the yields that you're earning. They will fork our code, rebrand themselves under a different name, and maybe make some adjustments. And that actually happened to us on Phantom, where Grim Finance forked our protocol, changed a bit of basic solidity code in our contracts, and were exploited because of it. And you know, they lost millions of dollars in user funds, and yeah, so that's another big risk, where you have to be careful about investing with a new protocol that doesn't have a track record. So maybe that should be rule number 5 that I didn't talk about. You need to investigate the actual underlying protocol that you're going to invest with. Okay, so I've talked about the risks. I've talked about why we go into DeFi at all. But how do we actually evaluate a new opportunity that we uncover, that we read about? Maybe in one of these community forums or on Twitter or wherever, you've heard about something, you want to dig deeper into it and figure out whether or not you want to invest in it. So definitely you need to go read the docs and the Medium posts of the protocol. If something's unclear, you know, reach out. You never want to do anything blindly in this space. Look at the business case. Is it simple? Is it clear? Or is it grandiose and the world will change if you invest in this protocol? I think we can all understand which sounds safer. Who's the team behind the protocol? Are they anonymous? If they are anonymous, how anonymous are they? Do they have a track record? Beefy Finance is actually all of its, I presented myself as AllTrades. That's anonymous, right? But Beefy Finance was founded by people who wanted to be anonymous, but they also had a track record. People knew past projects that they had been involved with, and over time, just because Beefy Finance kept on performing, the track record solved itself. So there's lots of times where anonymous developers will create protocols, new projects, and people will come into it immediately. We've seen this on Phantom recently, and you know, this happens quite often. So there are different levels of anonymity and what you need to be worried about. The tokenomics is also key, very key in evaluating any kind of opportunity. Is the underlying token inflationary, kind of like what I described for yield farms, what they usually do? Or more stable? Or is the business case so compelling that you know it's going to grow faster than the rate of inflation on the token? And then, of course, last is the competitive landscape for whatever new protocol. Do they have competitors? Is there something compelling, special about them that will make them stronger than their competition, and so not just be an also-ran? One thing you can look for that is, like I said, the auditing firms, but also partnerships they might have. So Beefy is famous for going onto a new blockchain with partners, with the leading yield farm on a new chain. Like we're about to go on to Optimism, which is a layer 2 Ethereum chain. And we're going in there with partners who are actually established there and want to work with us, so that we could do a mutually beneficial sort of thing. So that having partnerships are key. Am I running out of time or something?
Okay, you must finish. Okay. So 5 minutes again.
Okay.
5 minutes again.
Yeah, I think we're almost done. Oh, let me just show on the previous slide. So you can see also some of the information that you can find, like on Beefy's site, is a safety score for a token, which will break down what sort of risk there might be or what you want to look at. Market capitalization, impermanent loss, are the smart contracts that are involved well understood? Does it have is it battle tested, that sort of thing? So that's it. This is my last slide. Making smart decisions in DeFi is not easy, but with practice, like I said, and starting small, being careful about it, you can go somewhere with it and gather yield. Okay, thank you.
Okay, thanks to AllTrades. Wait a moment, if someone have a question, se qualcuno ha qualche domanda da fare ad AllTrades, ok, c'è una domanda lì. There is one question. Ok, per favore portate il microfono, grazie mille, perfetto. Ok, thanks, prego.
Hey AllTrades. Ciao.
Hello.
So my question would be, you mentioned that the founders of Beefy are anonymous, right?
Yeah.
And I mean, to me, that would always be a questionable decision. And what are the drivers for them to stay anonymous?
The drivers. Well, crypto is an unregulated market, and it was also started, by Satoshi Nakamoto. He's anonymous, or presumably it's a he. And I think it's part of the ethos of the industry, and also the lack of regulation, and the amounts of money that can be involved. And because it's such a murky area, and like I said, it's kind of the ethic of the community has a lot of anonymity involved, that, at least for me even, I'm not so concerned about staying anonymous, but in fact, I'm not at all, really. It's more of a way to fit in. It's more kind of just the way things often work. And you will see in DeFi especially, most of the teams are in fact anonymous. So I don't know, you just get by osmosis, by working in the industry, you feel strange by being public about your persona. So I don't know. That's the best I can really describe it as, is that it's unregulated, and some people just want to be extra careful in that regard. That's why I emphasize the idea of a track record.
Thank you.
Mm-hmm.
Okay, thank you, AllTrades. Someone else? Okay. One more.
Hi, and thank you for your presentation. I wanted to ask, before going to an audit firm, what are the security steps you think a DeFi firm should take? I mean, technically speaking.
What steps should a protocol take before they offer their code to an auditing firm?
Yes, because before recurring to vulnerability assessment, penetration testing, that is done externally, that of course is a good way to test the secureness of code base. But before this, what do you think the team should remind, and what are the steps to take before going to an external, let's say,
I understand.
assessor?
I think that's a great question, really. A lot of it depends on, you know, the seniority of the developers doing the smart contract code in the first place. Do they have a track record of writing solid code? Do you feel a lot of comfort in them, in what they did? Or do you want to get a second opinion before you actually spend tens of thousands of dollars trying to get an audit done, which may take a month or 6 weeks to have performed by a respected auditing firm? It takes a while. It's not something that's done immediately. If you find an auditing firm that will do a turnaround in a week, that's actually a huge red flag. You can't trust that firm. So I would say there's another thing. So the strength of your developers and how comfortable they are and how comfortable they make you in thinking about your code and what you're going to bring to market and what you're going to bring to an auditing firm. There's another way also is by partners, by having a partner, getting them attracted. So one of the things that Beefy does is we offer our own sort of a Beefy audit. We don't brand it as an audit, but if you want to partner with us, our developers actually dig in very deeply into the actual code, and we do our own audit, which we actually rely on a lot more than any kind of auditing report that a protocol may bring to us. So if a protocol can get a partner who actually does that sort of thing for them, and the user community respects that, because like at Beefy, we don't put anything on our app, we don't vault any farm which we're not comfortable that has any kind of exploit vulnerabilities inside of the smart contracts. So we do basically our own audit. So that's another way that you can battle test your code before you actually hand it over to an expensive auditing situation. That's probably the best answer I can give.
Thank you very much.
Okay, thanks to AllTrades
My
for
pleasure.
your speech.
Yep.
Thank you.
Thanks, everybody.